Hello, wonderful people. You are joining in to a conversational series. I am Jacque Vaughan, broker, owner of Mentor Realty.
Woo.
And I deal with a lot of people that are interested in knowing things on a very intimate level. They just like to absorb so much information. So I had the idea to have some conversations with industry professionals in real estate and record it so that you can kind of hear some of the conversations we're having on the back end and kind of get some information that you need, which may be difficult to share within a conversation. To start the series, I was thinking that Katie Zacherle would be my absolute best first guest because in the time that we have worked together over the last few years, we are close professionals, but also friends, especially in talking as wives and moms, which is really great to be able to have not just a professional relationship, but a friendship. So, Katie Zacherle, thank you so much for joining this conversational series. You and I have talked that we are going to concentrate on conventional loans today, but I'd love to hear, as a mortgage lender, please share where you do this type of work.
Sure, that's great. Well, Jacque, thank you so much for having me be a part of this conversation series. It is, I don't know, I think it speaks to the person that you are and the quality of investment you make in the people, the clients that you work with, that you keep them informed and you look out for their best interests. And that's what I try to do. And it's probably why we connect so well. I am a mortgage advisor and strategist. I work now with Atlantic Bay and I am all over Virginia, but I focus primarily on the Richmond region. I myself live in Chesterfield and it's a great, great place to be. Um, and I have the privilege of working with just a myriad of clients and client goals. Although I think that I shine particularly working with our first time home buyers, say folks that are over the Northern Virginia life that want to make it down to the slightly slower pace of Richmond, or families moving through transitions, having new kids and moving up, um, maybe moving through a divorce and figuring out what life looks like after, or maybe they're starting a business or have a business and they want to figure out how to leverage their homes to help them with that. Basically, if you need to purchase, refinance, invest, you need a strategy, and I'm your girl.
Can I say that blue background is just bringing out your eyes? It looks good.
It's all a strategy. I'm trying not to lose my shoulder in it.
So I feel like there's always a lot of conversation about grants and how you can put less money down, but I'm often asked by people, I have saved 20% down. Is that what I should put down or should I put down less? How would you answer that question?
Oh gosh, I actually think this is the most prevalent question that I receive. Um, and I have to answer it with that great old, it depends. I mean, truthfully, if we're having a conversation about something you want to achieve, we're going to talk about, why are you buying? Are you buying so that this can be your primary residence where you're going to live for 5 or 10 or 20 years? Is this a stepping stone kind of property where you're going to be for 2 or 3 years? Is this something you're going to, live in for the short term, but then hold as an investment? All of your answers to that, all of your goals and vision may change how much money you need to put into the purchase. Your desired payment, the interest rate that you want, all of that is affected by the amount of money you put into the transaction and the program that you use. So I suppose I should start with the great myth of conventional loans is that you absolutely have to have 20%. to get started. And I'm happy to report that that is not the case. I mean, maybe you need 20% to get to the desired payment you want, or to make whatever you're trying to do fit into your budget. 20% down is that magical space where mortgage insurance, which is an insurance you pay as a buyer monthly or in a different method that we can break down later, to allow you to put down less money and have a lower interest rate than you might otherwise have. But you can get into a conventional loan if you're a first time buyer for as little as 3% down or 5% if you're not. And then there are all the numbers in between 3 and 20 that could be used. So at the risk of rambling, it's a big decision, and it's a conversation you should be having with your lender. And they should be showing you, this is how your payments affected if instead of putting down 20, you put down 5%. I want to say, based on current rates, if you were to put an extra $5,000 down on a purchase, it only changes your monthly payment by about $35. So bump that up to $10,000 extra down. Or the same works if you're lowering your loan amount by that amount. It changes your payment by about $70 a month. Now, don't hold me to the math. These are rough estimates, again, based on a particular price point and interest rate. But when you think about it that way, it kind of makes that big chunk of money seem a little less impacting, wouldn't you say?
Yeah, I'd also be curious, how much do you have in savings, and if something happens fund. So it does, saying it depends is really, really critical. So when we talk about conventional loans, it's really good to know that you only need to put 3 to whatever amount down. What is a conventional loan? So for me, I always compare it to a government backed loan like FHA, VA, USDA. What is a conventional loan? What does
I
that
love that question. So, pardon me for how I break it down, but I like to say that a conventional loan is a pretty relaxed loan as long as you, the borrower, meet some tougher criteria. So the conventional loan's designed for the person with very strong credit, with good income, with solid job history, who maybe hasn't experienced a lot of financial setbacks, late payments and bankruptcies. Asterisks, you can get a conventional loan if you have been through any of those things, but there are wait periods. The point of the description is that the conventional loan is more critical of you, the person, the borrower, and less critical of the house that you buy. So the conventional loan is the one that we leverage if you want to buy an investment property. That is the only loan you can use to buy something that is purely investment. It's the only loan you can use for a second home. And a conventional loan, like I mentioned, is a little more forgiving of houses that maybe need a little bit of love. I'm not talking about roofs caving in or foundations that are completely destroyed. But if your or house has shaky handrails, if there's peeling paint, if there are sections of flooring that have come up, the conventional loan is going to be more forgiving. Whereas if you go with a government loan, like an FHA, which stands for the Federal Housing Administration, not first time home buyer, then those loans are less critical of you, the borrower. They're much more forgiving if you've had some financial setbacks or if you have a lower credit score. And they often allow you to potentially buy at a higher debt ratio, which means that in the scenario where you're buying the house, the amount of money you're putting into your house payment might be higher than with conventional, or the amount of money you're putting into your house payment plus all the monthly debt you carry is higher than a conventional. Not always the case, but sometimes. But in exchange for the flexibility it gives you, the government loan is much more critical of the house that you buy, and it needs to be a little more move-in ready and meet some more specific codes.
I love that breakdown. That makes a lot of sense. So, with all that being said, what is the downside of doing a conventional loan? Would you say that they cost the same as far as closing costs and interest rates?
That's a really good question because it comes up a lot. Um, maybe there's a client who's right on the cusp of they can go with the conventional loan, they can go with an FHA, and how do you decide what the best option is? So typically when I'm evaluating why maybe the conventional might not be the right choice, it would usually come down to could they afford more home if they went with the government backed loan? Now, why could they afford more home? Well, the first reason is that often lately, the government backed loans, because they charge mortgage insurance, because they have additional support behind them, their interest rates are usually a little bit less than the conventional loans. We're not talking caverns of difference, but a little bit less, enough to make a difference. Um, and sometimes, if you're not a first time home buyer, maybe you sold a home and you're moving into your second one, maybe you don't have 5% to put down with the conventional loan. Maybe you need the 3.5 uh, down payment that the government loan requires. In this case, I'm talking FHA. There are other government loans that don't require even that much. Um, so for me, usually the downside is just there might be an interest rate difference and there might be a down payment difference. And sometimes it's about because the government loan might let a person have more than 50% of their gross monthly income in monthly debt carriage. Sometimes we need that to get into the house that they're in need of. And conventional would never let you cross over that debt threshold. I feel obligated to say I am not in the business of putting people into homes they cannot afford. I am not in the business of pushing people to their maximums in order to get into a house. But there are sometimes strategic reasons. Maybe you're using the income from one member of um, a partnership buying a home, not both. So you can fit into a specialty program because one person on their own maybe is stretched to the max of their income to buy the property, but they get better terms or something doing that on their own. Again, a good mortgage lender should not leave you eating ramen and panicking at night, wondering how you're going to make your house payment.
So on paper, what is that percentage of what's affordable versus what somebody feels comfortable with?
Oh, that's a super question. I get where you're going. Okay. So, and if I derail, feel free to reel me back in. Um, so if I'm talking with a client for the first time, like here, can you be my stand-in, Jackie?
Of course.
All right, Jackie. So you are looking for your first home. You're paying about $1,500 a month in rent right now. What do you think a comfortable mortgage payment would be for you? We're talking taxes, insurance, all that included.
I would like to keep it the same 1,500 because there might be some maintenance that I don't have in my current place of rent, like
Okay.
yard and larger square footage as far as the utility bills.
Right. Okay. So you're thinking about it the right way. Now, this sounds like the same question, but let's pretend you walk into the perfect house and it checks all the boxes on your checklist. In fact, it adds things to your checklist because now that you've seen that these things exist, you need to have them. What is the absolute most per month that you would feel comfortable paying before you just close the door, walk out and say, "No, ma'am, can't do it."
2,500.
That's a big range. That's awesome. So thank you for sharing that with me. Now, Jackie, you're salaried. So what is your annual salary right now, dear?
To say 50,000.
Okay. So how we analyze your qualification in mortgage land is pretty simple. And because you're salaried, you've made this really easy on me. Thank you. That's kind. We take that 50,000 because that's your gross income and we just divide that by 12 so we get your monthly income. So for me, I come up with $4,166 and some change. That's your monthly gross before anything else comes out, taxes or otherwise. Now, in a really, really conservative universe where we do everything the way that mortgage land would like us to, we would like your housing payment not to exceed 31% of your gross monthly income. So I just take that income and multiply it by 31%. And in that case, now I want you to know this is the absolute most conservative. This is not your max approval. The base for you would be $1,200 and maybe $92. That would be perfect. Everything is golden in mortgage land.
And
In
50,000 salary doesn't get you what it used to.
I know, girl. I know. But I'm happy to report there are lots of things going on in mortgage land to try to make things easier on you. But we can go higher than this. I like to say the conservative maximum, if we ran into some bumps, I know that we could get you approved up to 40% of your gross monthly income. And this fits right in line with where you're actually comfortable. 40% of that 50,000 monthly is a little over $1,600. I've got 1,667 for easy math. And if we really, really wanted to push it, really wouldn't want to do it, but maybe we take you to 45%. And that would take you to a payment of about 1875 monthly. So it's not quite up to the 2,500, but we would talk about, income you might have otherwise, or different ways we could approach that to get you where you need to be. So that's how I walk clients through it. That is a basic pre-qualification. I've done no extra digging. I have not verified a thing. I have not looked at your credit, but that is the basic way that a mortgage lender would analyze income. Thank you for being a great client, Jacque.
When people are like getting ready to get ready, I think that information is helpful to know, like, am I even in the ballpark of what I'm looking to do? So that was a really great way to break it down.
Well, thank you. At the end of the day, and you do a great job of this, I think we really have to focus on people's goals and their vision, and then you set the reality. And unfortunately, in this market, it's hard to get anything in the Richmond area for, I'd say, under 2,000 a month. But
Our average sales price here is about 400,000. So, I mean, I think depending on how much you're going to put down, 250 is going to get you closer to $2,000. So,
and if the rates keep going up, it just comes down. I would say the average payment I'm seeing for a low down payment on a 400-ish $1,000 purchase is somewhere in the 2000s. I would say the mid range.
I know that you mentioned trying to figure out, should they do a government backed loan or a conventional loan? I would say, like, realtors in general like to promote a conventional loan as far as getting your offer picked through others. And just talking specifically through how critical a government backed loan can be to the house. So, sellers can see that as one more obstacle they have to go through as far as having their house critiqued by the appraiser versus a conventional loan. They're going to look past a lot more things.
Can you maybe break that down a little bit more for the audience? If I'm a buyer's agent and I'm coming to you with an FHA or a USDA offer, what goes through your mind? And I'll stop there.
So in Virginia, one of our protected classes is source of income, right? So a seller really shouldn't discriminate on a buyer based on where the funds are coming from.
Mm-hmm.
When you are working with a seller and you're talking about all the contingencies of the contract, and appraisal is a very big contingency. And so depending on the loan type, the checklist that the appraiser has to walk through is longer for a government loan versus a conventional loan. So if the house is brand new, I don't know if the seller is going to care as much, but if it's a house that was built before 1978 and has peeling lead-based paint throughout the exterior, as an agent, we really need to prepare that client that the appraiser might require that there be no peeling lead paint, because it can be dangerous if consumed by a child or pets. And so that is when it can be a little iffy. And we don't know. I've had appraisers literally point out an inch of lead paint, just a
What?
little inch. Like it, most of it was good, but it was just this very small area that had and lead paint looks like alligator skin. It has that cracking to it. So that can be an obstacle. Again, if the house is pristine, then you're good. I guess the only other thing that I would add is, when you walk through the house with your agent, they should be pointing out things based on your approval that can come out. I remember at one point I don't even know what there's a piece on the water heater that appraisers don't like, and appraisers would always bring up that piece. I can't even remember what it's called, but it could be something very mechanical and simple that appraiser could point out on those government loans.
So you might have just taught me something. I never pretend to be an appraiser. I know enough to be dangerous and give you some guidance on don't offer that type of loan on that property. But again, I don't see everything. But I didn't think they were that into it. I knew they had to be able to cut the heat on and the water heater needed to work.
Yeah, and every appraiser is different, right? And their standards and what they do. So,
Well,
uh,
that's excellent.
yeah.
I did think of something. Another reason that we sometimes switch from conventional to a government loan is that a conventional loan, well, let me back that up and say, when you're making an offer on a house, you as the buyer might ask the seller to cover some of your closing costs or your expenses. Frankly, especially right now, when I would argue we're not in a buyer's market, but in terms of the seasonality of real estate, the winter time seems to be a time that's a little more advantageous for buyers to be purchasing because there's a little less competition, and homes that are on the market at this time of year, they need to sell. There's a reason for the move because who likes to carry a box in the ice and snow? Um, so we more often this time of year than any other see requests for seller concessions. So a request that the seller pay towards closing costs. Conventional loans, if you are putting the bare minimum down, 3 or 5%, we only allow you to ask the seller for up to 3% of the purchase price in concessions. Let's say you can't put more money down and that's where your cap is. And you need more help than just 3% of the purchase price. Then we might switch to an FHA loan, for example, which would allow you for virtually the same money down to request as much as 6% from the seller in help. And that comes in handy, doesn't it, sometimes, Jacque?
Yeah, it really greatly impacts what you have to bring to closing. Like you mentioned, reducing the sales price impacts you, $35-$70 a month. When you get $5,000 that you don't have to bring to closing, that's $5,000 in your pocket that can go towards updates. I guess what I always find confusing is there is a minimum that you have to contribute before you get money back. Does that apply to conventional, and how do you know? Because there has to be something to apply the funds to, right?
Yes. So as a borrower, you always have to come up with your own down payment. But coming up with your own down payment could be a gift from family, a grant from an organization, but it can never, ever come from the seller. So and a lot of the grant programs have changed their guidelines around this, but it used to be even if you were receiving a grant or something like that, 1% of the down payment needed to come actually from your physical pocket. But that's really not the case anymore. Mhm.
Okay, that's good to know. So, what would be the disadvantage of doing a conventional loan? I
Hmm.
guess we did talk a lot about that as far as concessions that the seller can provide. It
Yes.
may have a slightly higher interest rate, but more critical on the buyer versus the property. Um,
Yes.
Anything else you can think of as a disadvantage?
I think the only other thing, if you want to consider it a disadvantage, is if you're not a first time buyer, the minimum down is 5%, not say 3.5 or 0, like some other government programs. Um, I'm a big fan of the conventional loan, and I'm a big fan of it because if you have an interesting situation with your income, or if you are moving through a divorce, or if you own a business and we need to look at 1 year of tax returns and not two, conventional just has, they're not even loopholes, but it's more fun for me to call them loopholes than to call them guideline exceptions that allow you to get creative. And we're not talking, fuzzy fraudulent business. We're talking about realistically looking at a person's situation this year versus comparing a person's situation over 2 or more years. Um, it's I love it. It's a great program if you need some flexibility. The only downside is, you've got to be in charge of your credit. You, Mr. or Ms. Client, you need to make sure you're paying your bills on time. You need to make sure that you are not exceeding more than 50% of your credit limit on your credit cards if you can help it. Like, do the things you can do to keep your credit score healthy, and that will set you up for greater success with the conventional loan.
I'm gonna put you on the spot. Can you think of an example of a loophole or
Oh
some?
yeah.
Oh, you're like, I got
Oh,
it.
I got them. I'm ready. I live in this. I am an 85 to 95% conventional lender because of these things. Now, it doesn't mean I don't do FHA. It doesn't mean I don't do USDA. It doesn't mean I don't know a lot about them, but conventional is my baby. One thing that conventional will let you do that the other programs will not, and this, uh, unfortunately, I have to do often. If a parent needs to buy for a disabled child, um, a parent may own their own home. And typically, if you already own a residence and you're going to buy for someone else, or if you're going to buy another home, you've got to put a larger down payment down. Um, and you typically would have to buy another property that you are not going to live in as though it were an investment property, which means you need to put 15, 20, 25% down and pay a much higher interest rate. But conventional said, that's not fair. You know, I had a client with a daughter who had had a stroke, was disabled in a wheelchair, but still needed her own place to live, but she couldn't go back to work while she was rehabilitating. We worked through a conventional loan to allow the parents to buy a home using only 5% down. And they took advantage of the purchase interest rates, not the investment property interest rates, which are lower. And that right there is a really meaningful loophole. And it works in the reverse. If a child needs to buy for a parent, um, again, these are things I do regularly. That's one of my favorites. Um, but then there are so many more. If you get me going, I'm never going to stop.
Does that apply to like the kitty condo situation as well? If a child is going to school?
It's not intended to,
Mhm.
um, and I'll just stop it there. I'll say it's not intended to,
Okay.
but there are things you can do to help in that situation as well.
I'm always curious, like what kind of documentation is needed to
Um,
make the child or parent, you know,
to
able.
consider them disabled and able to qualify. So actually, I could pull the guideline up for you.
It's funny to see how excited you get talking about these things. I'm like, oh, okay.
I am such a nerd about it. We were talking earlier about how we got into the career path that we're in. And if you had told college Katie that she would be doing mortgages for a living, um, she would have, I don't know, thrown her hands up and probably cried about it. I am an English, Latin, and Greek major, and worked in nonprofit, and that was what I wanted to do. But my father had a major stroke as I was graduating high school, or not high school, college, and I came home to estate plan. He's doing great, by the way. None of you all need to worry. And I fell into finance and have been doing it since 2009. And I love this. It is all puzzles. It is all about helping people realize a dream. And isn't homeownership an incredibly meaningful dream? I mean, the stability that it offers, the platform for starting a business, for raising children and breaking, systemic financial burdens and just changing lives. I'm so into this.
It
I'm
definitely changes lives for multi-generations.
Yes. So to answer your question, that is not the answer I wanted, Fannie Mae.
So while you're looking for that, what is the reason, I meant to ask you that earlier, that you decided to go into helping people with mortgages specifically?
So I had the opportunity to work in a bank and I handled everything from like budget planning and whatnot. Did just short of high commercial lending, but honestly, the most fun was in mortgage. And I hate to say it like that. Like it's just fun. It's that it's always new. People have a dream they're building toward. We conquer that mountain together. We celebrate. There's an end result, and then we can start again. But I think mortgage has this perfect pairing of dreaming and problem solving for a real purpose that just really excites me. And then of course it's all the things I told you before about the ideology of it all, the impact and the meaning. But from a just get up and do it and be excited about it every day point of view, that's why. And here we go. So Fannie Mae does not require any documentation to support the eligibility of handicapped or disabled adult, child, or parent as occupants of a primary residence when the borrower, that means the parents or the child respectively, that is taking out the loan but not going to live there, is not occupying the property. So I've never had to provide proof. Once I had an underwriter just ask to write a letter, have say the borrower state, I am buying this for my disabled parent. And that was more than sufficient. And that was more just to explain to Fannie Mae or Freddie Mac, one of the entities that buys the majority of conventional mortgage loans, explain to them why we had the borrower on the loan listed as owning another property as a primary residence, and then also buying a new property as a primary residence. That might have gotten a little technical, but
No,
that's
that makes a lot of sense. So is it limited to parent-child relationships? Can you do it for your aunt, your uncle, or any other family member?
It is intended to be a direct blood relationship. With that said, again, we're not going to blood test you. And it's just like when giving money. It used to be that for some loan programs, the gift can only come from a family member. But if you have a non-related friend who has been part of your family, essentially for your lifetime, who is going to argue that? So I suppose the answer is no. It doesn't have to be, but that is the intention. So it's a relationship like that.
I see. Interesting. I'm learning so much.
Mm-hmm.
So
I'm glad this exists because it just makes so many things attainable for families. And I worry a lot about our seniors living on fixed incomes, where their social security check might be the cost of a mortgage these days. And this is a way that a family could help their elderly that want to live alone.
Yeah, that's a really good point, because having to put 15 to 25% down on a $400,000 property can price a lot of people out of that opportunity. So,
Great questions.
yeah, tell me a little bit about, like, when somebody is trying to figure out if they should do a 15-year, 30-year, or maybe even should they do an ARM? What is an ARM? What are your thoughts on that? Or do you just keep it simple at 30-year fixed rate? even though the interest rates are the highest they've ever been in a century.
So, yeah, I'll say that generally speaking, right now, I focus on a 30-year fixed period. The average person in conversation, and this is going to be a ton of generalities. So, if this is not you who is listening, okay, but this is generalities. The average person I talk to receives a fixed income, or they're hourly, generally kind of fixed. Even if they're self-employed, they know what their budget is, and the idea of variability in their housing payment scares them, and they want the lowest payment they can get. So the concept right now, while the interest rates are higher, is let's get things as low as possible, and that generally means spread the debt out over a longer term, which right now is 30 years. um, we're not going to address anything about the 40-year mortgage. If that's what you're here to talk about, person, just move on. So I'd bring up 15, 10, 20-year mortgages if the client wants to discuss that. If they, I really think about, I firmly believe that the loans that are being taken out right now are going to be refinanced. So whatever financing you're putting in place is not your 30-year financing. And I want that to sink in with everybody watching. The financing you are doing today is not going to be your financing for 30 years. The average person either moves from their home or refinances, I want to say every 7 years. And so that's generally the time frame that we look at when we're planning how long someone is going to be in a house, or how long someone is going to hold financing. Now, everybody's situation is different. That might be different for you. If we're looking at a 15 or 20 year on the refinance in several months, we would be talking about, okay, how long are you going to be here? What is your goal? Are the rates actually better at 15-year or 20-year? Sometimes they are, sometimes they're not. And there are a lot of factors that impact that I'm not going to dive into, because I don't feel qualified to explain it in a way that makes sense. So I badly answered that question, but it's one of those, it depends on what your goals are and how long you're going to keep the house. I did have a client last year buy an investment property, buy down the interest rate with points, and set up a 20-year loan. That's not how I recommended we do it, but that was what made them comfortable, because they wanted to be making a larger impact on their principal every month with a shorter term loan. And they wanted to buy down to a rate to get to a payment, even at that 20-year, that made them feel good. Typically with a client, I'm going to math out, if you buy down your interest rate, so if you pay money to make your interest rate lower than what the market average is, how many payments do you have to make to recoup the investment you made to lower your rate? And how many years are you going to have this loan? So that leads us into the ARM. An ARM scares most people, again, because an ARM is an adjustable rate mortgage. Most people think that means that the rate could change at any time, your payment could change at any time, but that's not how they work. They do have their place. If you are buying a house because it is cheaper to buy your house than it is to rent, but you know you're going to be in an area for 2 years or 3 years or 5 years, it doesn't make sense necessarily for you to get a 30-year fixed rate loan. An adjustable rate mortgage has terms for how long you have a particular interest rate. If you find an adjustable rate mortgage that has a much lower than the going rate offered to it, maybe you want to do that. Let's make up numbers. If the going rate on a 30-year is 8%, but you can get an adjustable rate mortgage for 5.99 or 6%, that's a huge monthly savings. And say you lock in that 6% for 3 years. Someone might choose the adjustable rate mortgage because they either think they're going to leave that house in 3 years or less, or they think that the interest rates are going to go down in 3 years and they plan to refinance and lock in something fixed. Because right now, they're not locking in a 6% interest rate for 30 years. They're locking in an adjustable, but that's better than locking in 8% for 30 years for some folks. Does that make sense? Did I leave out something?
It's perfect sense. And I think a lot of people are trying not to deal with what we dealt with in 07, 08. So I bought a home in that time. And I was also told most people do not stay in their house more than 7 years, get this interest only loan. So the only loan that I had was fixed, I believe, for 5 or 7 years. And when I went to refinance, when that time came up, we were in a housing recession in which what I owed on the property was more than what I can sell it for. And so that was a situation where I was going to have an adjustable rate mortgage and be upside down. I think that the mortgage industry has learned a lot from that time. And we don't anticipate a housing recession just because of the low inventory and our population numbers. But at the end of the day, it's like if you don't have a crystal ball, we don't know what the rates will do or what's going to happen. I feel very confident in our area and where we're located in accordance to the East Coast, and how the population is driving, our prices are going to continue to rise. It's been very significant year over year, but all the experts have been wrong as far as the interest rates, at least in talking, in the beginning of the year when they were closer to 7.3, 7%. Like at the end of the year, the rates are going to go down. And now that we're towards the end of the year, the rates keep going up. Do you have any predictions or, what are you guys thinking is going to happen?
Let me grab my magic 8 ball.
I
I
say
mean,
crystal ball, you say magic 8 ball. They both, have power.
oh yes. Well, I mean, and that's the thing is professionals in this industry that genuinely have the experience and the knowledge to make educated guesses, and that's what they are getting this wrong. We were told we should expect 5.5 by now. Then we were told 6.5. And then the point at which that would happen has continued to get pushed out. But it will happen. The rates will come down. What the Fed is doing, and all of this is not just the Fed for the record, but what our government is trying to do is limit inflation and just affect the markets. To help stabilize the economy. And it's unfortunately having this kind of effect on us. I am trying to find a way to not sound political and backtrack. So my prediction, I think we're going to see another rate hike. And I think it'll be this year. I don't want that to happen. We're heading into Christmas. Everybody would like to have homes. Mortgage lenders and real estate agents would like to, continue in their jobs. But I do think that just the forces that are at work are going to have to bring the rates down. But we are not going to see these 2s and 3 and maybe even 4%. That is not where we are headed. We're talking probably 5s and 6s. Right now, I'd be really happy with 7. So that's what I think. And I'd like to add that the mortgage industry knows that buyers are suffering. Fannie Mae and Freddie Mac have gone back to their initial charters. They want to see primary residence owners. So folks that want to live in their home, not investors buying houses. And they continue to make it more difficult for investors to buy. And they try to change guidelines to make it more plausible and possible for a primary residence buyer to buy. And since we're talking conventional, I got to share this with Jackie. I was very excited about it. I mean, I'm leaping up and down inside. So another reason sometimes we would switch to a government loan would be, say you have an opportunity to not just buy a single family home, but you get to buy a duplex or a tri or a quad, but no bigger than that. If you were going with a conventional loan, you might have to put 15 to 25% down to get into one of those properties, even as a first-time home buyer. And doing that, I mean, those properties knock you out of grants and other funding because they're not single family, and you're putting more than 10% down, which is a little nugget to hold on to. Most of the programs want you to put 10% or less on the property, but conventional has changed their guidelines. Typically, I would move someone from conventional to FHA. So instead of 15 to 25% down, they could put down 3.5% and buy their duplex. Now, conventional has said, we really want more people that actually want to live in these properties to buy them. So let's make it more affordable. We'll let them put 5% down, and that's a game changer.
Yeah, that's incredible because so many people want to house hack, which is, move into the property, have that income help support you, and then later you can decide to move out if you should decide into a single family, and then you have equity that you can pull from with a lot of different ways. So I'm really glad that's something that they're doing. I had a situation in which, well, I've had a few situations where my client wanted to buy a house cash and then
Mhm.
quickly go and refinance it. And that's when I learned about the restrictions in doing that. And I guess it's
Yes.
a reason to slow down investors. So what is that rule called? They call it
I know what you're talking about. It just left me because you asked, but it's that refinance rule, and
so there's a certain time that if a property is bought cash before you can get any type of mortgage on it.
oh, it's usually 6 months, but then some guidelines change to make it so if you bought a property and you finance it's delayed financing. That's what we're talking about.
And
Delayed
finance.
financing. You buy with cash, and then there are very specific guidelines about when you can actually pull funds out of the property. Um, and I had a buyer this last year. We knew we were buying. He was going to keep the property, work on it for a while, then refinance it to pay himself back for the work that he did and reinvest in his business, still live in the property. And the guideline changed, and we couldn't refinance for 12 months instead of 6. So, um, this is another little Katie asterisk. Um, I am told in the same breath that mortgage lending is too critical, and then told it is just that the market's going to crash and that it's going to be the fault of these lenders making these bad loans when new products come out. We are working through one of the most critical analytical times in terms of how mortgage lenders analyze buyers. But we're not going to see the kind of crash that we saw in 2008 and 2009 when I was talking to people in a bank about how to avoid foreclosure on their home. We're not going there because guidelines like this are coming into play. Fannie and Freddie want primary residence owners, and they don't want people pulling cash out rapidly. They learned from their mistakes, and we're being protected.
Yeah, I mean, I think when we talk about crashes and recessions, I think the industry is very important to note, with supply and demand as far as, inventory and availability of homes, it may be luxury homes that feel it and maybe not that mid-market because people need to move.
Yes.
I love your Boss Babes mug.
I had to pull it up. Mm-hmm. Represent RVA.
Yes.
Here.
One thing that we didn't talk about is how awesome conventional financing is with condos, because government financing of condos can be extremely difficult.
Oh, and to break that off in another topic is it's almost hard because so much of what we've already talked about overlaps into the condo sector. But yes, condos are complicated because it's almost like having to navigate an entire HOA program for one purchase. And there are considerations in some programs as far as how many people in a condo community are investors and how many people are primary residence owners occupying the condo. And without putting too fine a point on it, conventional is significantly more flexible there. And I've run into this one pretty often in Richmond, and I'd be very curious to see or to hear what you've experienced too, Jacque. Um, there are some homes that have been turned into condos, and maybe they were owned by one person, and there isn't really a condo association set up. Um, and like that's a no-go with FHA. That's not going to happen. You don't buy that with a government loan, but conventional has workarounds to help make it possible.
I've been told that it's fairly easy to create a condo, in the city of Richmond. I don't really know what that involves, but some of the articles that we keep reading is like how much office space we have. So if you are an investor and you can convert that office space, let's say, into condos, because it's not necessarily a townhome, that's like an instant opportunity. And if you don't have yard space and all these amenities, what type of management do you really need? It could be minimum. So it makes it very complicated. And it really, in my opinion, condos can be such a affordable home option, but because the government guidelines are so difficult and really only accessible to conventional buyers, it continues to price affordable housing out. So
that is so well worded. And I'm very curious what it's like in other markets, but I find in our markets, when you have an affordable condo, something that's priced 100,000 or something, that sounds appealing, finding these condo dues to be, gosh, almost as much as that mortgage payment.
Right. The ones that are less than 200,000 likely do not qualify for FHA or have a very high HOA. And my understanding is it's really the same in other markets. And I feel like the culture of Virginia is that would take a little bit longer. So having this dense community of condos, I think a lot of people don't get it. Like, why would I buy a condo when I can have a single family home? But now that housing prices are rising so much, people are now considering it where they haven't before. But to wrap your mind around paying, 300, 400,000 for a 1-bedroom condo when you can have a house for that same price, it's not for everyone. And I do think that buying a condo in an area where you can't afford to buy a house make more sense of a purchase versus just buying a condo in, let's say, a similarly priced, because condos will appreciate slower than a single family home.
Such good insight. I see an increase in condo purchases also among our elderly, are those retiring that don't want the maintenances and chores. So as you were playing with developers, I hope that we really do see mall conversions into senior living, and we need community at
Yeah,
every age.
I'm pretty sure. I think Willow Lawn has just announced some different. I mean, there's just a lot going on as far as
Great.
office conversion. So it's going to be exciting that our municipal areas are allowing more dense housing as well, because it's just awesome to be able to walk to shopping and not always get in your car to go everywhere. I think people miss that.
Yes. And one little fun fact with conventional analysis of condo dues, association dues, um, sometimes you pay an inordinate amount of, I guess we'll call it HOA, condo association dues, because the condo association is actually covering the exterior of your condo. They're covering a lot of utilities. They're making your homeowner's insurance cheaper, and they're roping into the costs things that you would be paying for on your own as a single family housing owner. So what we can do in mortgage land is deduct from the condo association dues the things that are utilities.
I didn't
You
know that. That's awesome.
fun facts, Jacque.
That's
So
great.
we can sometimes take a condo that on the surface appears to be unaffordable for a client and make it affordable according to the guidelines by removing those costs from the analysis.
Mhm. Oftentimes the insurance is significantly less for those reasons of what the homeowner's insurance because of what the condos including. So that's really awesome.
Mhm.
Note. Thank you for sharing all these great tidbits.
We just we go back and forth. You teach me, I teach you.
And
Every one of you should work with Jacque. She's amazing.
you know, you would think we would get to a point where we just know it all because we've been doing it for so long, but it doesn't matter. It's constantly changing. And so for you to stay on those guidelines is critical and really helpful.
Thank you so much. That really has become the job. I tell myself, thank God I am an A+ kind of student and I want to know and I want to read because it really, it's almost impossible to stay on top of all of it. And we have to constantly be going back and looking through for these changes. Um, the nice thing to note is if you are moving through the loan process and you're actually under contract and the guidelines suddenly change, they very, very rarely instantly affect you. The changes are made and take effect many months later. Um,
So do the guidelines come out on set days or they just change whenever they want?
Whenever they want. Usually we get a daily announcement and it's just, oh, we tweaked this, and Olive Mortgage Land goes, please stop.
Do you ever know ahead of time at all?
um, so sometimes we hear this is on the table, like this is on the docket for discussion, and effectively a vote will occur. And then, I mean, there's a mortgage lobby, there's a real estate lobby to try to make positive changes for both the industry and the consumers of our product more affordable, accessible, or be set up in some other fashion. So yeah, we get some insight. And actually, that might be a good note, unless you had another topic, for us to pivot to some big changes in your industry. Um, I have been of the opinion, it's not actually a big deal. It just sounds like one, but I am starting to see the effects and it is starting to affect buyers. So now that I've made that sound really, really ominous, Jacque, can you tell everyone what we're implying?
Yeah, so the time of the recording, we've had, I think it's about our third or fourth lawsuit regarding realtors and the way that the seller traditionally will pay both the seller side and the buyer side. Recently, we had almost 2 billion rewarded for the just the way the commission structure is. So traditionally, as a realtor, when I represent a buyer, the seller pays my commission. And so some sellers have said, why am I paying someone to negotiate against me? It's not fair. And
Oh,
that's been the way it has been for a very long time. And a lot of it is because, well, I don't know why it's that way, but it may be difficult for a buyer to have cash money to pay an agent the commission because lending currently does not allow that for it to go into the loan.
yes.
So my opinion is that this will impact our industry. I do not think it's going to be something that will happen overnight. For one reason, this lawsuit happened in another state. And with my training and education with our current association, they have slowly been making changes to be compliant and to avoid copycat lawsuits. So I do think it will impact us. I think that agents are in one of the few industries that whether you're a first-time agent or a very experienced 20-year agent, the pay is the same. And so people may start qualifying their agents a little bit more, and just looking for specific qualities from their agents so that they are empowered. I do think that agents will figure out a way to get paid, and there's a lot of ways for that to be done outside of the buyer paying it out of pocket. But what, I have been told is there's just going to be more separation between the seller and the buyer commission. So instead of the seller paying for both, those funds may come from different sources.
Mm.
And I can go on for longer, but I'm curious what your colleagues and what the mortgage industry is saying about, that change.
So I'm going to give you some camps. So I'm not necessarily saying these are the Katie Zacherle approved opinions. They're just things that are being said. So one way of looking at it is that the law technically has only changed by $1. I believe that the law said a buyer's agent could receive as little commission as $1, if I've simplified it. And now the law states that the commission can be $0. And I just want to say for the world out there, real estate agents, quality, talented agents that understand the market, that work their connections, that negotiate like monsters. And I'm going to say the way that Jacque does. A contract from Jacque Vaughan always blows my mind. This woman fights for her people in the most professional way. And those people really work. It's a lot of hours. This is a profession. This is a job that they clock into at very odd hours, and it is significantly more than 40 for someone who is really working it. And if you think about the last time you bought a home, or some of my clients that have been doing this with an agent for over 3 years, she has poured more than the commission she makes into gas and time. You could never afford a real estate agent if they calculated for you what they actually spend getting you into your home, or selling it, but definitely on the buyer side. Anyway, now that I've gone on my vitriolic tangent, I got derailed. So this income needs to be paid. And so if you did all that kind of work and you received $0, I mean, how would you feel? So I have seen in contracts coming to me that listing agents are getting paid one set commission and the buyer's agent are getting a reduced one. Or this happened very recently. Correct me if I'm wrong, Jacque, but when you're working together with a buyer, and you've decided you want to work together, you sign a buyer agency agreement stating that you represent that person and that you're entitled to a commission of a certain amount. Does it always read 3%?
So our local association being ahead of this,
Mm-hmm.
I think it was July, changed the language. So before that, it would say whatever the MLS pays. So
Mm-hmm.
partly why the National Association got in trouble is because to put your property in the MLS, you had to provide compensation to a buyer. You had to be cooperating. And so when you look at antitrust, that could be wrong. So our buyer agency agreement used to say, I will take whatever the MLS says. And the MLS used to say, you are allowed to go as low as $1, but most of the time it was, within the 3% range. So just being proactive, the MLS says you should put the amount in on what you're willing so that we're clear, because we can't afford to work for $1 or less.
Perfect. So we did have this come up. It was not one of my closings, but one of my committed closings. the listing agreement said the buyer's agent would be compensated a certain percentage, but the broker buyer agency agreement stated that a buyer's agent would be paid a higher amount or percentage than what the list was given. So at the closing table, and I don't think this was done maliciously, I think this was just the way the paperwork crossed. The buyer was on the hook for the difference in commission for the buyer's agent. So in that case, I think it was a full 1% of the purchase price that the buyer was coming to the table to pay for the buyer agent. Now, this is really an agent caution. Please have this discussion with your buyers. Please set the expectation of what they will or will not be required to come up with. And then you, as a buyer watching this, ask the questions of your agent. What happens in those scenarios? What kind of agreement are you signing? And then I hope that we're all professional and we don't hide those fees and that language from those involved in the transaction, because that was a nasty surprise for the client to see. Whoa, I'm bringing another, 1% of a $300,000 purchase is $3,000. 400, that's $4,000 that they weren't expecting to bring. So I hope that conveyed as clearly as I wished it to.
And part of the lawsuit said that the buyer compensation needs to be public. So when you are surfing the internet and you see a house for sale, that compensation is now public, where it wasn't a while ago. And, to your point, Katie, I would say that an agent that is professional and knows what they're doing, they're not going to blindside you with something like that. They're going to have conversations before you even look at the house, right? If they don't have the expectation of lowering their compensation. And, even in our area, we know which listings have that, because there's some really large teams that offer, less than standard commission. And so make sure you are taking the time to ask questions, like Katie said, so that you are partnering with someone that's not going to just put their best interests, but make sure you're informed and prepared.
That was beautiful. And I'm curious where it's actually going to go. And the mortgage industry is very actively talking about, how do we get in front of this for our agent partners? How do we get in front of this for our buyers and for our sellers? Because there are impacts all the way around. So there are ways loans can be structured that can help cover some of these costs, but it's not, it is explicit in the many of the guidelines that a buyer really can't pay this commission, or my vocabulary has left me, but basically everything's being reworked and we're looking for solutions to make this again affordable. And that's another thing for first time buyers. The grant community is changing, and we have a panel discussion coming up with 4 major grant providers in the Richmond area, and this may not air before that occurs, but they're working together, kind of hand in hand, trying to figure out how to structure these grants on top of each other to make sure that scenarios like what I described don't occur and derail someone's purchase.
And, the real estate industry, whether you think about like, oh, wow, this realtor is getting this percentage, realtors are employing a lot of people. Like, it's definitely its own economy that impacts, contractors and all these other people. So I'm really happy that, we're trying to be proactive, and I feel pretty confident that it will be fine and figured out. And it's going to take some time, because change takes time, especially in Virginia, in my opinion. But
yes, we'll tie it up in the legal system until
right. Well, we've had some really good tidbits and conversations about conventional loans. So I'd like to wrap us up by, maybe asking you a question. Let's see
I
here.
disappeared. Whoops.
I know. I'm like, what's my question?
A
So
floating head.
sometimes when we are dealing with professional relationships versus friend relationships, we can't be as transparent if you're dealing with, let's say, your friend and something you might be a little bit less or more concerned about sharing with maybe a more professional relationship as far as advice in anything real estate, whether it be building your team or just how to navigate the process. What's something that you would share with a friend that you might not be as comfortable sharing with someone in a more professional environment? I know that's a pretty difficult question.
It's very difficult because I mean, the way
Like
I run,
everybody's my friend.
yes, I was like, I run my business that way. I'm like, I love you instantly.
Right.
Um, and I want to give you all the insight. But what I might share with a friend,
Or any inside tips or tricks that you haven't talked about.
I think maybe, let's see where this goes. Not every mortgage lender is created equal. And if you get a no somewhere, it doesn't mean it's a no everywhere. Um,
And you've prided yourself in rescuing so many loans. And some of the things that we have been able to do, it's like, oh, we can do that just to make sure that our clients got in a home has been absolutely amazing from you knowing the guidelines and all these details so well and loopholes.
you. Thank you. Um, you know, I think that maybe this is what I would say. Um, I had this conversation with a client yesterday, um, and it was, do I work with my family and friends, or do I work with someone I don't know? Um, and I think the advice I would give is, oftentimes I tell people starting in an industry, don't target your friends and family. Cut your teeth, go out there, fall on your face. Don't do it with your friends, don't do it with your family, because honestly, we're the most critical of our circle, which is terrible, but it's true, isn't it? Um, and but when you're making a decision like this, do you work with your friends and family? Do you work with someone outside? I'd say have conversations. See who explains things to you in a way you understand. See who you feel comfortable with, who you really believe is looking out for you the way that you want to be looked after. Um, because an interest rate difference of like 1/4% or even 0.5% is not that big a deal in a monthly payment. Um, shopping for the lowest rate, or the lowest commission is not usually, I wouldn't call it the right path, because this is a huge decision. You're going to have a ton of questions. And as we've illuminated today, there are lots of guidelines that change constantly. And me personally, I would want, I even if a client didn't want to work with me, I would want to know that they're working with someone that they trust will look after them. There you go. There's my ramble, my transparent advice.
Yeah, I want to compare it to you can pay an electrician, let's say $200 an hour, and they're going to come in and do something within 15 minutes, and you're paying for the years of experience they've had. Or you can do it yourself, spend $10, but maybe, 7 days to complete that same task. So
Yeah.
really buying into experience, personality, and trusting somebody that's a professional means a lot. So
Mhm.
you are definitely a trusted partner of mine. I appreciate all that you have done for the community of clients that I have had, and very grateful for you to be on here and just share all your knowledge about conventional loans today.
Well, thank you. I'm not going to let you escape that easy. If you put me on the spot with that crazy question, what's your answer?
Yeah, I just pulled that and I was like, what would I
It's
say?
hard.
So, I think in dealing with friends and family, they don't always hear this. And it's kind of in line with your response. sometimes it's not, and even the conversation we were having offline, everything does not boil down to money. And when you are new, let's say a first-time home buyer, you don't always know what questions to ask. You don't know what you're looking for. So sometimes you just have to play the game and then figure out what your preference is. So I like to tell people, and I try to pair people personality wise. I think building that rapport, feeling comfortable with your loan officer, because it's such an intimate process. The questions that they ask, do they care about your goals, or do they see you as a check? You can feel that. And so knowing someone that's invested in your success, they're going to take the time to figure out, okay, well, this area doesn't work. Am I going, what loopholes can we take advantage of, versus just telling you no and then you having to start somewhere else. So when dealing with my friends and family, there are lenders or maybe even realtors in other areas that I can recommend that may be the cheapest, but that's not who I would recommend, because I'm looking more for personality, care, compassion, and all those other things that you cannot quantify. But there's a certain energy there that I'm looking for.
It's beautiful. I find myself still doing this as a seasoned professional. Sometimes it is hard to break down the friend barrier and remember to behave like a professional. Uh, um, but
See, my industry is different. I feel like I'm very professional and people are always surprised, like, wow, you're so professional, because realtors can be very chill. So it's like,
mhm. It's funny. It's so funny. I really do find myself having to remind myself, do the same things for your friends, like, or your family that you would do for other people. Like, this is still this, it's the same process for them.
right,
Um,
yeah.
it's, I find it hard to toggle between the two modes sometimes.
I just find my
Especially if
friend,
we had this conversation and then
right,
I see you at 5 o'clock.
yeah. And then they want to, call you at all hours and stuff where your clients may not. But that's another story.
Yeah.
Thank you so much for joining um the conversational series and doing a deep dive into conventional loans. So I hope you guys enjoyed listening to this, and we're excited to hear your feedback.
Yes. Thanks, Jackie.
Thanks. All right. So before I
It's still recording, I think.